I'm Sonali Basak, the Chief Investment Strategist at iCapital, and for the latest episode of Beyond 60/40, I am joined by Alisa Wood. She's a partner in the private equity business at KKR at a really interesting time, by the way. Thank you for joining us here.
Thank you so much for having me.
So, private equity actually surpassed, for the first time in about a year, private credit in terms of flow of funds at iCapital. Clearly, there's interest in private equity. There are a lot of question marks around the asset class that I'm hoping you can debunk for me, if you will. So you started the other day at a Bloomberg conference saying that there are actually more private equity funds out there than McDonald's. This caught a lot of attention. I'm with you. The second part of your statement here, the reason why people should understand that is a really important one, isn't it?
I think it is. It is interesting, right? They're based on Preqin. There are 19,000 private equity funds in the U.S. over the last, whatever it is, 10 years, and there are 14,000 McDonald's, right? That's a stark comparison. But I think the more interesting part of the sentence was the fact that the dispersion of return between those managers is greater than ever before. So if you actually look at, well, I say this all the time, it's the who, it's not the what, right? It's not private equity that's interesting. It's if you can find a good manager where they can buy good companies and make them great, you have an outsized performance. That's the whole goal. Now, if you do look at that dispersion of return, call it the first quartile to the third quartile, we'll assume the fourth quartile folks take care of themselves. But the dispersion of return, depending on cycles, could be anywhere from 1,400 plus basis points. If you compare that same spread in public equities, it's 200 to 300 basis points. Right. So what does that tell you? It tells you that who you invest with is the reason to invest. If you're just investing in the median, you probably shouldn't be investing in private equity, but no one wants to say that.
Well, what's interesting about this to me is we hear day in, day out from clients who say, well, the land is very large in the world of private equity. How do you really parse that land and figure out where to invest? What are the qualities of a great manager? Bring us behind the KKR secret sauce.
Sure. No, it's super interesting, right? Because what made a great private equity manager 20, 30, 40 years ago is not what makes a great private equity manager today. It's absolutely changed. And what's the saying that we love at KKR? It's if you don't like change, you're going to like irrelevance even less, right? So you've got to evolve and you've got to adapt. It doesn't mean you leave all the other chapters of the book by the wayside. It just means you keep growing and you add new ones, right? So today, what good looks like is having a manager who uses asset alpha, right, to drive the performance. It's not cheap leverage, right? It's not just multiple expansion, right? We like to say anybody could buy a company. You just got to pay enough, right? It comes down to what you do with the business. So if you're buying a good company and you help grow it, growth is the secret sauce. It's not cutting your way to greatness, right? It's making the company more valuable. And you can do that through operational alpha in the business. You can do it through M&A. You can do it through, honestly, reinvesting in the talent. The talent piece is probably one of the most misunderstood pieces of private equity, right? And at the end of the day, if you invest in the management teams, if you create alignment of interest and really create this whole concept of universal ownership, we actually believe you can drive results not only better, but you could do it faster. And those two things, the velocity of change is a big piece of the secret sauce.
I want to go into some of those aspects in a moment here, but are long gone the days where leverage made all the difference here. When I say leverage, you had the better part of a decade and a half, really, where you had interest rates so low, and you saw a lot of private equity firms being able to ride that wave. Is that game over?
I think it is. I mean, listen, I also think, though, that interest rates are, quote unquote, not high, right? If you look at the average of where they are today over our 50-year history, they're not all that outsized. I think we just got used to an incorrect normal. And there was a normalization of really low interest rates. And by the way, that covered up a lot of sins at the end of the day, right? So if you look at our returns, and I think this is really interesting, less than 5% of our returns come from leverage. Right. So what does that mean? You have 95% of your return that you got to come up with somewhere else. We're putting 40, 50, 60% equity in a deal, right? That means that you have enough free cash flow in the business to actually reinvest in the business. That CapEx is hugely valuable when it's not there just servicing the debt. And I think that's how you can get outsized returns in terms of growth and really that acceleration. Now, that's not all private equity, right? Some private equity managers have a very different view on that, right? And I think we've learned lessons in terms of where does growth come from? How do you reinvest in that? How do you make sure at the end of the day that it's not a leverage game? Now, when the industry was started in the 60s and the 70s, the whole concept of lending based on cash flows versus lending on assets was really novel.
LBO.
LBO, the name of the industry, right? So I think at the end of the day, it's not foolhardy to think at one point it mattered. Of course it did. But then, honestly, the next chapters of the book, people caught up. People figured out how to do that. Then what happened next? You had to be industry specialists. Then you had to create operational alpha. Now you have to invest in the employees of the business to create that alignment. It just keeps growing, right? And I think at the end of the day, you've got to remember that the best managers are the ones who don't rent the resources. They own them, right? So they bring a team of people, dozens of people on every deal to make sure they're focused on what is the right capital structure optimization, what is that value creation plan and the operations of the business, how do you bring in top grade, best in class management talent, how do you look at risks, right? All returns are not created equal, not just because of the number, but because of the risk that's associated with it. How do you think about geopolitical complexity? How do you think about macro trends? All of that matters.
So it's a pretty stunning statistic. So less than 5% of returns are attributed to leverage, you said. So what about that other 95%? How do you think about the rest of that pie and really where that alpha is coming from?
Totally. I think the simplest way to describe at least how we think about this is you've got to control and make your own luck. Right? You can't be the 1980s, 1990s buy low, sell high, and hope for the best. Luck isn't a strategy, right? Hope isn't a strategy. So you've got to control that. So what we do is we bring in specialists, right? We bring in folks who understand how to operate these businesses and focus on that. Now, that allows you to buy complexity in a very different way, right? So when you think about where are we getting deals done right now, because I think one of the big myths is like there's nothing getting done in private equity. It's all quiet and we're all sitting on the sidelines. Very much not true, as you know. But when you think about what you're buying public to privates, right? You're taking unloved and non-core assets out of large conglomerates, and this whole transition from capital heavy models to capital light models. Having the resources in-house to be able to create that value, it allows you to lean into complexity in a very different way, right? And buying complex assets, that's typically where there's value. By the way, I didn't say assets with hair. That's very different, right? I didn't say distressed assets, but complex transactions, at least in our view, typically means there's more to do. So what we do is we buy the complexity, and in our value creation through all those resources we've just talked about, we create simplicity. Now, I also think one of the other pieces of this is, we see this in the headlines every day, can you actually get exits done right now, right? Are DPIs going down? Are realizations not happening? Also not true, right? And, back to how you started this with all the myths. And when you think about that, relying on levers other than financing, it allows you to actually create a lot of value that you then can go trade on in terms of your exit, right? So if you create that simplicity, folks want to own it.
Where are we in this whole DPI issue that we're talking about? And how do you explain it to, say, your parents, right? Because you're sitting here where large investors have been waiting for a return for much of the private equity industry.
Sure.
And those exits just not have materialized at a rate to return money to those investors.
Sure.
And this has been a years-long problem.
Yeah.
So what does it create in terms of somewhat of a vicious cycle for the industry? Because now those investors have their capital trapped in some ways.
Totally. So if you look at the data, I find this fascinating. I'm kind of a data junkie. If you look at the data, and this is according to Cambridge, right? Last year, and I think most people, if you took a test, would get this question wrong. Last year was actually the second largest year for realizations in, call it, the last decade.
2024.
2024.
Interesting.
Okay. Most people, if you picked up the page of whatever paper, you would not believe that would be the case. And this year, if you look at this year to date and what we're on track for this year, we will either be second to that or maybe third to that, but we're right on par with that to some degree. Now, how do you look at that data and then say, wait a minute, the industry feels like it's so behind on this DPI ratio? And it's because at the end of the day of the anomaly of 21. And 21, so much capital was deployed. Right? There was this boom bust feeling of private equity, which unfortunately, no matter how much we try to learn from these cycles as an industry, we tend to still kind of get wrong. But, if you look at 21, a lot of capital was deployed, which means the denominator and the ratio went way, way up. It wasn't that the numerator came down, right? So what does it mean? The denominator is like the NAV of the industry. Right, so more capital was deployed. Valuations have been rather robust, as we know, okay? So that denominator is a big nut. And what's happened is, even though last year, this year, we have very strong realization years, in terms of the context of the industry, because of that, I don't want to use the word bubble, but that inflation from 21, it's been harder to actually make a dent in it.
Well,
and that's the problem.
21 is kind of the ghost that just won't leave the industry
Totally,
behind,
yeah.
because you had valuations quite elevated. Then this was right before that heroic Fed hiking cycle, where then all of a sudden the cost of leverage got higher. And realistically speaking, since 2022, since that market drawdown, you did see asset prices start to elevate again. But if you look at the market, the public markets as a proxy, you didn't see everything rise, right? And it created this issue, it feels like, for the private equity industry, who may not have been able to exit a lot of these assets at those pre-2022 levels. Is that a fair way to...
Yeah, listen, I think that is partially fair. I also think there's been this like AI painting of what good looks like, right? So if you think about this, and I'm just going to look at the data in a couple of different ways. If you look at the S&P right now, a third of the S&P has some relation to, AI, right? And when you think about what is private equity actually investing in, the vast majority of what's private, okay, using the word private in private equity, 90% of companies that have 100 million more revenue are actually not public. Okay, so when you think about everything we hear around the AI boom and what's driving valuations in public markets, a lot of what is private equity is not touching all of that, right? We're using AI as a tool to drive value creation in our companies. When you think about productivity and innovation and just speed of transformation, all of those are really good value creation levers that we should all be employing and using. But that is very different than what you're seeing in the, NVIDIAs of the world or whatever else, right? So I think what's really important in all of this is when you own a good company and you buy it and you make it great, or you buy from good to great, what are you doing with the business and who are the owners of it? Now, if you're waiting to take a company public with the volatility in the public markets, now, by the way, the IPO markets look a lot different in the last couple of months than they did maybe 6 to 12 months ago, for the record. But the right company can still go public. But do you want to be waiting around for an IPO window? So the managers who have actually seen realizations come through are those that are using other sources to buy their companies. So 2/3 of our realizations, by the way, for every dollar we invest, we like to say we return about 2. That's the goal. And that's kind of the track that our history has delivered, right? So if you look at this point in time, right, 2/3 of our realizations are actually not coming from IPOs. Less than 20% of our realizations are coming from IPOs. It's coming from selling to a strategic. It could be another company. It could be a family. It could be another sponsor, for that matter. And that is where there's a lot of capital to be had, right? What do those owners want? They want simple growers. What do we want? We buy the complexity and then we create the simple growers.
So I'm going to now ask maybe what I think is the toughest question right now, because the private equity industry is clearly finally getting some interest back from investors in a lot of ways. You're seeing individual investors, retail investors really find more ways to access this industry. There is a deep fear under the surface that the individual investor is becoming the exit liquidity. How do you answer those fears?
So by the way, I get that question probably 10 times a day. So it is the question,
fear,
it is
right?
the fear, and it is the question of the hour, right? I think it's actually really simple. So in the Evergreen space, right, and I think that's the other piece of this question, right, the structures that these individual investors are able to access through, right? They should not be, at least in my view, in our view, they should not be the and takeout of these companies, right? So what does good look like in evergreens? It's not a one size fits all, just like it's not a one size fits all in closed end funds. It's no different,
or public
right?
markets,
or public markets for that matter, right? There is a difference between good and less good, right? There's no difference in that in any asset class. But the definition in private equity, at least in my view, what good looks like is making sure you're investing alongside and are aligned with the largest institutional pools of capital. If you're investing in something that's quote unquote other, right? You're buying from, you're getting the deals they turn down, there are lots of nefarious ways that you can play this, right? But if you get the same deal at the same time at the same price and you're in together, you're out together, you're aligned, well then guess what? That fear is gone. Now the problem is not everybody does it that way, right? And I think what we all need as an industry need to really link arms around is trying to make sure sure that we are educating our end clients, whoever they are, right? They could be the largest pension funds in the world, or they could be individuals, right? We need to make sure they understand what are the questions that they should ask when they're diligencing. What does good look like? And what does it mean for them? Do they actually know what they're buying? And if we do that right, by the way, that's good for everybody.
I think this question of diligence is really important, because when you have folks that are entering a private equity vehicle, then it seems to me that one of the questions should be, am I investing alongside the institutional managers? When said manager makes a deal,
right?
Are all types of investors afforded those same deals?
Right.
And what you're saying too is, and is clearly happening in the industry, some funds do, some funds don't.
That's right. And listen, I think it should be really simple, right? At the end of the day, are you creating an institutional-like experience for individual investors? Okay, and if the answer to that is yes, well, then here's how to do it. If the answer is no, well, then that's a separate issue, right? Then you better be really clear that what you're selling is other, right? But if you are creating that similar experience, and we say this all the time, there are two parts to this equation, right? There's the structure of these evergreens, and then there's what goes in them. If what goes in them, and at least in our case, is the same that our institutional partners get access to, well, then we should be fine. The structure alone doesn't make greatness, right? The structure is simply a facilitation vehicle that allows for some of the inefficiencies of closed-end funds to be taken out of the equation and to allow for a broader group of investors to buy these products. By the way, that's good. But you got to make sure that what goes in it is still part of that secret sauce. If it is, you're fine.
So how should investors be thinking about this asset class moving forward, right? Because you have these new structures coming into the world, and some of them are being branded as semi-liquid. But what we have been saying, at least, is if this is the money you should be putting into the fund and leaving there, right? You should, just because it's said that it's semi-liquid doesn't mean that this should be counted as a liquid part of your portfolio.
I could not agree more. By the way, I hate the word semi-liquid.
I do too.
I wish it could be like banished from the language, because all you hear in semi-liquid is one word. You don't hear semi, you hear liquid.
Right.
That's the problem in this. So here's the way I think about private equity and private investing. It has to be seen as a long-term capital appreciation asset class. And if it's not, well, then you just got it all wrong, right? So what private equity historically has done for literally the last 5 decades is it has allowed for a less correlated or uncorrelated, if you want to go as far to say that, return stream in a portfolio, right? So the way large institutional clients, pension funds, sovereign wealth funds, endowments, foundations have kind of used private equity over the last 5 decades is it's almost a hedge to their public equities book. So now the world has changed a lot, right? So if what you're buying in the public market, you can't access a lot of what you used to own, right? A private equity company, if you think about the size of the companies we're investing in, these are not companies you would ever have access to. If you think about the themes that you're investing behind, we like to say this all the time, we're buying things that you use every day and can't live without, but you don't even know you're using, right? Like it's not the sexy big brand name things, right? And that's important, right? Because that actually acts as a diversifier. But if private equity does its job well, it should deliver 400, 500 in best in class in the industry, 700 to 800 basis points above the public markets. And in periods of dislocation, it delivers 2 to 3 times that. Think about COVID, think about taper tantrums, GFC, whatever the case may be. That is the power of private equity, right? And that's what people want. But what you've got to do is you got to do 2 things in order to get that. One, you got to stay invested for the long term. Like if you're pulling the carrot out of the ground every day to look at it or possibly exit, like you're not going to have those returns, right? So we like to say you got to think in at least 5 to 6 year time frames in the semi-liquid space. And the second thing is you got to pick the right manager because they're all not created equal.
So before I let you go, I think the other hot button issue of today is artificial intelligence. And you got to it in some ways. So I've got to say, in an era where everyone's talking about AI and talent, you guys are leaning into talent at a lot of times when you're hearing a lot of people talking about AI taking the place of. I want to ask a different question about AI, which is not just how it's good for a portfolio, but are there companies across the private equity industry that are actually going to feel some real pain from being displaced from AI?
I'm a big believer that in a company, you're going to be one of 2 things over the life of your ownership. You're either going to be disrupted or you're going to be the disruptor. So you need to decide what side of that you're going to be on and what time frame that may happen in, right? So we think about AI in a couple different ways. One, it is a facilitator and a way to supercharge growth. And when you think about innovation, when you think about worker productivity, all of those things are really great. We, for instance, we bought Fujisoft in Japan. It's the backbone of Japanese, technology innovation. When you think about a business in healthcare like Cotiviti, right? AI is a huge piece of that. Those are really good, and that's in the healthcare space, but those are really good places to put capital to work. But we're not sitting here trying to find the next NVIDIA, right? Like that's not the point of this, right? The point of this is, at the end of the day, is to use it, at least in our view, as a driver of innovation and growth and better productivity at the companies we're in. That is the power of this, at least in our view. We got to invest behind people. Our assets, by the way, go home in the elevator every night. We can't forget that. So if you align that talent, you incentivize that talent, and you make sure that you're locking arms with that talent at the end of the day, you're going to create some pretty fantastic results together with those teams.
Before I let you go, also, there's a sense in this industry that the deal dam is breaking, that there could be a moment of more M&A.
Yeah.
And of course, we've talked about this in the past, that M&A is part of the KKR secret sauce.
Yeah, exactly.
You guys know M&A, and you know it as much as, if not better than anybody else, right?
Right.
So when it comes to M&A, what does your crystal ball say for the next year or so?
Well, listen, I don't think it's actually gone anywhere, if I'm being really honest. So maybe I'm going to take a really different stance on this. I think there's still great companies that M&A is a really big piece of our strategy, right? You could buy a market leader, and then you actually can go consolidate the industry. You can go really use that build-up strategy. We do a lot of that. I think what we're looking at right now is, and this is, I think, part of what we're seeing going into next year, into 26, is we're going to see lots of opportunities to go do that, right? And the more that we can strengthen the businesses we buy, either organically or through acquisitions, by the way, that's all a good thing for the companies that we own, right? It's all about growth.
Looking forward to seeing exactly where this goes. That is Alisa Wood of KKR. She's a partner in the private equity group. And I'm Sonali Basak of iCapital. You've been listening to Beyond 6040.